Hey everyone, welcome back. This is Kirk here again at OptionAlpha.com, and you're checking out the video tutorial that we do here each and every day on the membership side of our blog, where we go over all of our opening and closing or adjusting trades. Now today's Friday, March 14th, and we had a really busy day. We had a lot of opening trades, had a couple closing trades that we started to roll off here for March expiration that ended up being nice winners. And it took a long time for some of these trades to kind of come full circle, but this is really the name of the game. And today just really drives home that point that a lot of these trades, which had been losers for pretty much the entire month of March and the better part of February, have now started to turn over right here before expiration and started to become nice big winners. So I want to go over all those trades tonight. Stick with me. I know there's a lot going on. I'm going to get to each and every trade here, so you just have to stick with us through this video. It's a lot longer than some of our other videos that we've done because we're just making more trades. So you'll notice on the chart here that I have the opening trades and the closing trades for today. I'm actually going to stick with just the opening trades right now and talk about first IWM. And let me just move this over so you guys can see it. So the first one that we want to talk about tonight is IWM. Now IWM had a really bad day. It was down hard, and we actually opened a new trade to sell a credit spread against IWM for April expiration. But in this March expiration trade, we actually had originally bought a debit put spread. And this trade worked out really well because we bought a debit put spread, the 190, 180 put spread. So that put our break-even price right around 185 or so. And today we were able to sell that back to the market right here before expiration at a 640 credit. So we took in a nice $127 profit on the single option that we had. And what really helped us with IWM, and I'll go to the chart here so you guys can take a look at it. One, we had obviously the market move down below our price here of 185. That was kind of our break-even level. So yesterday it just eclipsed that level. Today it moved even further down below this level, so that really helped our position. But you'll notice that when we were trading originally, implied volatility was below the 50th percentile. So we had bought a debit put spread because IWM had continued to run higher and higher and higher, right? And so we wanted to take advantage of both the downward move in the stock plus potentially an upward move in implied volatility. So you'll see that implied volatility jumped to the 63rd percentile today, so that really helped kind of accelerate the profit in IWM for this debit put spread. But then also, we'll talk about later on in the video, it also gave us an opportunity to then sell a credit spread below the market to take advantage of this high implied volatility going forward and moving on to April expiration. So really good trade here today. Glad we could get out of it before March expiration. The next trade that we got out of today was actually an April expiration trade, but it just worked out to be a nice quick profit on this trade, and that was on XLF. So we had originally, again, bought a debit put spread, the 23-22 put spread for XLF, which is an ETF that follows the financials, and today we got out of it for a $72 credit. It was only $18 in profit per vertical that we sold back to the market, but after we sold back all four, it was actually a nice little profit that we kind of banked here today. If you'll remember from the video that we entered, the width of the strikes is about $1, so we paid about half of that, or just about a little over 50 cents. And so our max potential gain on this trade is $1. So that's the most we can make, and that's only if XLF trades completely below 22 by expiration, which is all the way out in April. Now, we've only had this trade for a little over a week now, so at this point we've made about 50% of the max potential profit that we can make on this trade. So at this point, it's just really prudent, especially with a debit put spread where you have a trade that's a 50-50 probability to begin with, to then go ahead and just exit that trade and take the profit off the table. And that's exactly what we did. We're not going to wait all the way until April expiration to potentially eke out another 25 cents or so in potential profit. We made really good money in just a couple short days trading this thing. So we entered our position right around here. I don't know if we got the high or not. It was right in this clump of days here. So we got exactly what we thought was going to happen. We took advantage of a quick move down in the market. And now you'll notice again, as with a lot of other things today, implied volatility shot above that 50th percentile. So at this point, we don't want to get rid of this, or we don't want to keep holding this trade. We've had a really good move in the market, in the underlying. We've had a really good move in volatility, the right direction. We were trading low volatility, so we wanted volatility to go higher. And so we just need to get rid of this position and move on to the next one. All right, and then the last trade we exited today is EEM. Now this one is one that we rolled off here for a loss. So we actually sold back to the market a vertical call spread that we had in EEM for March. And this was more of a hedge that we had entered a couple weeks ago. And we were just trying to take advantage of potentially some positive delta in our portfolio, get ourselves tilted towards the bullish side as the market was continuing to run higher. So we had originally bought the 39.40 call spread. We bought it for a little over 50 cents. And sold it back today for a $21 credit. This is really part of our strategy here at Option Alpha, is to take profitable trades off, but as we get closer to March expiration, trades that we know are not going to be winners or that are very far from the actual price of the security right now, we want to take those off and savor some of the profits. So we're not going to let everything go completely all the way to expiration, just lose this 21-cent credit that we have right now. At this point, EEM doesn't look like it's going to be trading much higher than where it is right now, especially not in the next 6 days. So we just want to take this one off and bank the loss for now and move on. All right, so let's get to the opening trades here today, and I'll just scroll up so you guys can see these. There's a lot of trades that look very similar today, and I'll go over those because these are the ones in the clump here that you'll see, these top 4 trades. They're all credit spreads that we entered today. So why credit spreads today? Well, today we saw in most of these securities, and I'll go over them individually, but we saw generally implied volatility go higher as the VIX went higher because stocks were going down. And this is what we need to do as options traders, is take advantage of these market opportunities. It's really hard, and I understand it because I get a lot of emails from people, all the coaching students I talk to on a weekly basis. It's hard to find good trades when implied volatility is low and the market's continuing higher. But this is really the opportunity that we have as option traders a couple times throughout the year to really pack on the trades very heavily with regard to selling options, selling premium, being creative, selling iron condors like we're going to talk about in EWZ, etc. You got to take advantage of these high implied volatility times to really get some premium on in your portfolios, and then let the market, again, work itself out. Let market cyclicality take advantage of what we know is going to be true, that the market's going to move up and down in flows, and we're going to have an opportunity to take these off at a profit at some point in the future. So let's go over these individually. The first one is AXP, and this is American Express, and we went back to the well here. We already have a position currently for March expiration in AXP that we're actively trying to get rid of and move off the books, and it's kind of on the edge of being a winner or being a loser, so we're just going to give it a couple extra days. But we wanted to go back to the well here because AXP implied volatility is still very high. And so we took advantage of this by selling the 92.5, 95 call spread. So we want AXP to trade below 92.5 by April expiration. And because of this, we took in a credit of 65 cents on this one vertical that we sold. So if we go here to the chart of AXP, you can see exactly where we placed our positions. We go to AXP here, and you'll see that AXP has continued to move down. The key here being our deciding factor, implied volatility above that 50th percentile. So implied volatility right now is fairly high in a lot of stocks, and that gives us an opportunity to sell option premium and get further away from the market. So our current first strike is at 92.5, which puts us about right here. So we gave ourselves a little bit of a cushion. So if AXP does rally up between now and expiration, we also gives ourselves a little room to be wrong in the direction of where it's going to go and still be right in making money. So that's a great great example here of giving yourself a little bit of a cushion. And what allows us to do that is implied volatility generally across the board for most of the stocks that were traded today is much higher today than it was in the beginning of the week. Now, as far as actual trade goes and strike selection, I want to go into that here so you guys can see that as well. So you'll notice that we actually have that position still for March expiration in AXP, and we're going to try to get rid of that one here in the next couple days as we get into expiration week. But here out for April expiration, you'll notice where we placed our positions. We took in a credit that was just about a little less than 30% of the width of the strike, so it was a nice credit. So we're trading with odds in our favor, but you'll notice that on the call side, the first strike at 92.5 has about a 33% chance of being hit. And we get that figure right here with this probability of being in the money. So what that basically means is that the first strike, 92.5, by April expiration, which is 35 days away, has about a 65% chance that it's not going to hit that strike. So a 33% chance that it is going to hit that strike, and about a 65% chance that it's not going to hit that strike. So At that point, we're trading well with the odds in our favor. This is not a 50-50 probability trade. This is a really, really good trade that we actually want to continue to make. And if we can make these all day, I'd be a happy guy trading left and right. The next trade that we entered is very similar to the AXP trade, except it was on the put side. And you'll notice that the next 3 are on the put side. This is on JP Morgan. We sold the 52.5 puts. Took in a little bit less credit for the same width of strikes as APX here, and we sold 2 of these. Again, same thing really kind of goes into play here with JP Morgan as AXP, and that's that implied volatility was much higher on JP Morgan today. It was continuing to trade low, so we think at some point there's going to be a little bit more cyclicality. We could see a jump back up in financials and JP Morgan, hence why we got out of things like XLF and why we got into things like JP Morgan, etc., to take advantage of this move and kind of rebalance our portfolio. We have a lot of positions for April that are still bearish, and that's great because that's helping us as we move lower, but we also need to start adding some more bullish positions in here, and you'll notice that we started doing that today. COF is Capital One Financial, so again, another financial that we added here today. We sold the 67.5 put spread. Took in a little bit better premium here than on JP Morgan for the same width and strikes, and that was 53-cent credit on this one. Sold 2 of these as well, and same thing kind of goes here for Capital One as JP Morgan. We had a huge sell-off in that stock here today, so taking advantage of that along with the implied volatility being in the 68th percentile here for Capital One. You'll notice that up in the top left-hand corner, it's 68. A little hard to read being yellow, but it says 68 percentile. Again, Capital One continues to move lower, so we sold our premiums well below the market, giving ourselves room to be right in both the direction and implied volatility continuing to compress down as we get towards April expiration. The next trade that we want to go over is the IBM trade that we have here today. IBM was, again, very similar to Capital One and JP Morgan. Went back to the wishing well here as we exited this trade down below this IBM vertical debit spread that we exited. We then re-entered a new trade in IBM for April expiration. We sold the 175, 170 put spread, took in a nice premium of 90 cents on this one, and also, again, gave ourselves a lot of room to be wrong in the direction of IWM, but still make money on this trade. So you'll notice here on IWM, obviously had a really rough couple of days, got rid of it, made some money on the put side, and then sold our position at the 175 level, which is all the way down here. So you'll notice that we gave ourselves a lot of room to be right on this trade. And what allowed us to do that, but none other than the implied volatility being as high as it is right now. If we go to the actual strikes, I want to take a look at the strikes and show you guys those. We go to the IWM trade, you can see our position here. And same thing here, we're trading with about 70% odds of success. You'll notice I'll highlight the IWM strikes that we're trading here today. And you'll see here that the 75 strike, the probability of it being in the money by expiration is only 29.21%. So basically 30% chance that that strike is in the money by expiration. So what does that mean? It means that we're trading with a 70% chance of success. There's a 70% chance that IBM does not trade down to 175 by expiration. And this is really the type of high probability trading that you want to engage in. And it only happens in these times where implied volatility is above that 50th percentile. If it's not above that 50th percentile, you really can't make these trades and get this type of premium. You can still trade at the same probability level, but you're not going to get the premium that makes it worth the risk to make that trade. All right, the last one, or second to last one I want to go over here tonight is EWZ. So EWZ is a little bit different. We haven't done many iron condors, and that's because implied volatility has been low. But EWZ is a really, really good trade. I really like this trade. It's a very balanced trade as far as where our strikes are, and I want to go over this one in detail. So what we did here is we sold the 42-44 calls and then also sold the 35-33 puts. So you can see this is a very balanced trade. The strikes are evenly spaced apart on both sides. They're both $2 wide, and that makes our credit on the total trade $45 per iron condor that we took in. So we took in about $90 in credit for this whole trade, but have very even, wide spaced positions on EWZ. It gives ourselves a lot of room to be right on both sides and kind of brackets the market going forward. So let's take a look first at the chart of EWZ. and you'll notice that implied volatility is much, much higher on EWZ than practically everything else today. It was up at the 70th percentile. So just as a little sidebar, when implied volatility is this high, up in the 70th, 75th percentile, even if it gets up into the 80th, that's when you want to start actually kind of moving away from some of the just regular credit spreads that are above the 50th percentile and start moving towards things like iron condors, butterflies, strangles, straddles. Those are kind of your more exotic strategies that really take advantage of super high implied volatility. You don't want to be trading a strangle with a stock that has implied volatility at the 50th percentile. It's just not high enough to be trading that type of strategy. But as it starts to get even higher than that, up and towards the 70th, 75th percentile, then you want to start trading over from things like credit spreads, and again, going after iron condors, butterflies, strangles, and straddles. And we talk about this in our strategy guide right here on the membership side of our website. So you notice here that EWZ is trading basically right at 39. So what we did is, and I'm going to go to the actual trade tab so you guys can see where we placed our positions for EWZ, but we went about an equal distance apart from the market for EWZ, both above and below, as far as a percentage is concerned. So the percentage move in EWZ, both above and below, we spaced our position very, very equally. So there's an equal opportunity or an equal probability of the stock moving up to our first strike at 42 and an equal probability of the stock moving down to our first strike at 35 on the put side. And I'm just going to connect these two probabilities here. So on the put side, the probability that this stock gets down to 35 is 18%. And so what we did is we went up to the call side and said, okay, we want to match that probability. And you'll notice that the first strike that is very close to that and practically the same as that is the 42 strike put calls. So that's what we did. We based our first strikes off of a matching probability of being in the money at expiration. If you're a little bit more conservative, you can move out to maybe the 10% level. And so in that case, you'd match up this one here, the 33 put option, and you would probably match up about the 43 call option as your first level strikes. So hopefully that's really, really clear, and it's really key to understand. A lot of people have questions about, where do you place your strikes for an iron condor? How do you determine that? How far to go on either side? Now you'll notice that it's actually a little bit further on the put side with our probability. So our strikes are not evenly spaced as far as dollars are concerned. It's a little bit further away from the money on the put side than it is on the call side. And that's just generally because stocks obviously can fall much faster than they can rise. And so these puts are further away dollar terms, but they have the same probability of getting to the $35 strike as they do getting to the $46 or $42 strike. So hopefully that's really clear and really good example of how to choose your strikes for your iron condors and where to place your trade. This is a very even trade, a very neutral position. So we just want the stock to trade in between these ranges between now and expiration. And at some point we want to see a drop in implied volatility, which will help bring us a little bit of profit here. All right, the last trade I want to go over, and this one actually got executed after hours, so I did send this trade alert out to everyone. It got executed a couple minutes after hours, so I got it out right to everyone. These trade alerts always at Option Alpha come out about a minute after they get executed live on our trading platform. So these aren't fake trades, these aren't suggestions, and then we talk about fills. These are trades that actually get filled in my live portfolio. They get automatically executed and sent out to you guys before I even get email confirmation of them. And this one is a vertical call spread that we sold in the VIX. Now, we've talked about the VIX a lot on this blog and on these videos. Now, the VIX you have to trade a little bit different than your conventional credit spreads. And in this case, what we did here is we did exactly what we've done numerous times before in the past, namely back in February and January, where we sold a call spread in the VIX, and we actually sold a call spread that was slightly in the money. So in this case, the 17.19 call spread, which is $2 wide, we took in a credit of about 50 cents. So that moves our break-even point up to 17.50 on the VIX. So all we need to happen is for the VIX to close at April expiration below 17.50 for us to keep our entire premium that we sold of 50 cents. So if we actually go to the chart of the VIX, you can see exactly where that level is. And it's a little lower than where it is today, and it closed today at 17.85. But we've done this before in the past, and you can go back to all the video archives. We've done it here. We've done it here when the VIX was up near 21, and today we're starting to build another position in the VIX, and if it goes higher, we'll just keep adding to this position. But basically our line in the sand is 17.5. So going back all the way for the last couple of months, you'll see that the VIX generally doesn't stay up at this level very long. In fact, it only stays up at this level a couple days. So by making this trade, by selling this call spread, the 17.19, our break-even price is around 17.50, we give ourselves a great opportunity to make some money on a volatility move down in the VIX. So if stocks rally here, then we make some money on the VIX dropping. I wouldn't usually make this trade if the VIX was down here around 16 or 15, because you'll notice that it can jump up here and it can stay up here for a couple days intermittently throughout the year. But up around 17, 18, and definitely up around 20, then you'll start to see us become more aggressive with the VIX. And we made a lot of money in February trading the VIX. And really, I hope that the VIX continues higher. We're just starting to build our position in the VIX. So if it does continue higher, 19, 20, 21, 22, etc., we'll just keep adding to this position and moving our strikes up and building a really nice position in the VIX. So again, hopefully you guys enjoy this video. I know it was a little bit long. I know I'm out of breath talking about all this stuff, but I'm really excited about all the trades that we made here today. If you guys have any questions or comments, please add them right below to this video. And hey, if you guys really enjoy these videos, I know I don't say it enough, but please share them with your friends on social media. Help spread the word about what we're trying to do here at OptionAlpha.com. I'll get back to all the comments tonight or Monday before the open, and happy trading.